Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 105 on March 14th, 2020. I'm your host, Eric. And in this week's show, we will cover the trades from last week on Sibanye Stillwater, American Airlines, and Barrick Gold Corporation. And we discuss three new trades on Marathon Petroleum, Bank of America, and the US Oil ETF. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show, or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, this week, the market rebounded from its lows of the week, thankfully, but still ended up down. The Dow Jones Industrial Average fell 2,679 points, closing the week at 23,185 points. The S&P 500 index lost 261 points, ending the week at 2,711 points. That's a 10% loss and 8.8% loss in the Dow and the S&P 500 respectively. Now it's time for the topic of the week, and this week's topic is systemic risk. The equity markets overall right now are down 21% from the high just 4 weeks ago. That to me is evidence of systemic risk. So systemic risk is loosely the level of risk that is inherent in the entire market that cannot be hedged away or even diversified away typically. So it's said that a rising tide lifts all boats. Well, systemic risk reminds us that a falling tide lowers all boats too. When building a portfolio, we typically choose industries or companies that are diversified. I'm sure you all have heard of, portfolio diversification and its importance. And what that typically means is that, you have exposure to a variety of companies and industries that ideally are uncorrelated and will move based on different factors, right? That's all that means, is that the information that makes one company go up won't affect another company or if it does, it makes it go lower. So you're kind of offset. But by definition, you cannot diversify away systemic risk. One of last week's trades was based on a gold company, Barrick Gold. And gold typically increases when the stock market declines. However, you can get to a point where the market declines so much, so quickly, that there is risk to the entire financial system. So at that point, even gold will fall in value. So over the next few weeks, keep your eyes open for opportunities in assets that haven't declined as much, but still could. Real estate could be one of those. It will be affected if the current economy remains. The number of companies suggesting that employees work from home can and will affect two major industries, and that's commercial real estate and oil demand. So one of the ways to play commercial real estate is through some of these real estate investment trusts, otherwise known as REITs, that are available. Some of them have options. You might be able to buy puts or put spreads or sell call spreads or that sort of thing. Regarding oil demand, you're going to have fewer people driving to work, back and forth to work, which means that oil demand is likely going to soften, which means that this situation between Saudi Arabia and Russia isn't the only factor playing or taking effect in oil markets. So, just in general, look for opportunities. Don't allow this period to make you afraid. Look for the values that are out there because there are certainly some values. And seriously, if you live in Houston, Texas, can you at least save me a little bit of toilet paper at the grocery store? So that's it. Sorry to make light, but sometimes you just have to laugh at what's going on. But, definitely be on top of things. Definitely protect yourself and your family and your loved ones. and make sure that you guys are all prepared to sustain over the next few weeks, possibly even few months. So let's get into the trade review from last week. We're going to start with the covered call, and we looked at Sibanye Stillwater Ltd, symbol S as in Sierra, B as in Bravo, S as in Sierra, W as in Whiskey. At the time, the stock closed at $9.39 per share, and we looked at buying that stock and selling the March 10 call, collecting 40 cents, hoping for a return of roughly 10.7% in 2 weeks. Well, Sibanye Stillwater shares fell $4.27 this week, closing at $5.12 per share. The at-the-money call we sold lost 35 cents, bringing our net loss on the trade to $3.92. I truly hope you guys are seeing a theme in these covered calls. The naming of this trade is a misnomer. The fact that it's covered simply refers to, or simply means, that you have the shares to cover the risk of the call option going against you. As you can see, the bigger risk is the stock being cut in half due to the price of gold falling roughly 9.5% in 5 days of trading. So I discussed this trade type on the show because it's one of the most common option trades for retail investors. The other thing common in option trading is people losing money due to not fully understanding the risk. So there's a lot of risk in the covered call trade. Some stockbrokers will even tell you that it's a less risky trade, but not according to my math. This is actually a risky trade, and if you understand options, you'll understand why. It's the stock that gives you the risk, not so much the option that you sell. So our second trade on the week is the credit spread. We looked at American Airlines, symbol A as in Alpha, A as in Alpha, L as in Lima. At the time, the stock was trading for $15.97 per share. I looked at selling the March 16 half call spread at 24 cents, which can yield a maximum possible loss of 26 cents per spread. Well, American Airlines stock fell $1.66 per share, ending the week at $14.31. The out-of-the-money call spread is tough to price because the actual spread is priced 9 cents at 41 cents, meaning you would collect 9 cents if you sold more of the spread, and if you bought it, you would pay 41 cents. But we all know better than that. This is an out-of-the-money spread, and now it's even more out of the money. It has 5 days left to expiration, so I'm fully expecting to collect 24 cents on this spread because the stock is nearly $2 away from our break-even point. So I'm expecting this trade to finish in profit unless American Airlines stock pops this week. I'm not certain that we're through all the bad news on travel and whatnot. So if you place this trade, this one worked out for you. And our final trade review from last week was on Barrick Gold Corporation, symbol GOLD, G-O-L-D, G as in golf, O as in Oscar, L as in Lima, D as in Delta. Stock ended the week at $21.23 per share, and we looked at buying the March 21 call spread for 35 cents, hoping for a maximum gain of 15 cents or roughly 43% return in 2 weeks. Well, shares of Barrick Gold Corporation fell $5.56 this week, closing the week at $15.67 per share. The in-the-money call spread we bought is now significantly out of the money. In fact, with 1 week left before expiration, this trade is a complete loss. Now, you could still look for iron condors to sell, maybe collect a little bit of money from this market over the next week, but I don't like 1 week trades. This is another one of those times when you just take the loss and walk away. Historically, of course, gold trades counter to the stock market in times of crisis. So when the market has a significant sell-off, gold typically rises. Well, this week we saw prices of gold fall alongside the market. I guess there's a level of loss, of course, that reflects the possibility of a lowering economy. Possibly even, they're starting to say we might even see recession coming from this. So that's my hindsight view of the move in gold this past week. Regardless, this trade will expire worthless, most likely, leading to a full loss of the money paid to buy this call spread. So thankfully, because we bought the spread, the loss is capped. So a stock move like this would wipe out many investors. I mean, this stock moved $5, $5.50 in a week. But since we only had on a call spread that we bought, either way, we traded a spread. So our risk was defined from the start, and we just take a small loss and keep on ticking. So remember, your goal in trading is to be able to keep on trading, continue to grow your profits. If any of your trades, any single trade could wipe out your entire portfolio, you're trading too big and you don't understand risk. So step away from the computer after you close that trade. So that's it for last week's trade review. Let's go ahead and dive into the trade review for this upcoming week. And of course, this week is March expiration. It was tough finding trades for this week's show because all of the markets are priced so wide. So market makers, the guys who set prices for securities at the start and at the end of each day, they widen out spreads to protect themselves during times of increased risk and volatility. I used to be one. I used to be a market maker on the floor of the CBOE back in, we'll call it from 2001 to 2006 roughly. There was a year of that I actually was at the Philadelphia Stock Exchange, but I was a market maker, so I understand what they're doing. It makes it harder to price trades for this show. So take these trades for their educational value. If you like any of them, definitely look at the prices, dive in deeper, and decide if you're going to be trading alongside me. So we'll start off as usual with the covered call. And I told you just a few minutes ago why we discuss covered calls on this show. So understand the risk, know that there's a lot of risk, and understand why I'm talking about it on the show. So covered call, we're looking at Marathon Petroleum Company, symbol MPC, M as in Mike, P as in Papa, C as in Charlie. Stock end of the week priced at $24.92 per share. I'm looking at buying that stock and selling the April 25 call at $2.65, hoping for a 10.96%, almost 11% return in 5 weeks. Now you enter this trade by buying Marathon stock for $24.92 per share and selling the April 25 call at $2.65. This trade makes the most money if stock prices finish above $25 per share. The break-even price for this trade is $22.27. Now, the stock purchase would require $2,492, and you would collect $265 for selling the option. Our next trade on the week is Bank of America, symbol BAC, B as in Bravo, A as in Alpha, C as in Charlie. Stock ended the week at $24.16 per share. I'm looking at selling the April 25-26 call spread at 30 cents, looking at a possible maximum loss of 70 cents per spread. So you enter this trade by selling the April 25 call at $1.80 and concurrently buying the April 26 call for $1.50. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices stay below $25 per share. The break-even price on this trade is $25.30. You would receive, in real terms, $30 for each spread that you sell and have $70 at risk. Our final trade on the week is a debit spread. We're looking at the United States Oil ETF, symbol USO, U as in uniform, S as in Sierra, O as in Oscar. Stock ended the week at $6.96 per share. I'm looking at buying the April 7.5/7 put spread for 30 cents, hoping for a gain of 20 cents or 66.7% return in 5 weeks. So you enter this trade by buying the April 7.5 put for $1.21 and concurrently selling the April 7 put at 91 cents. This is the debit spread because we are buying the spread. This trade makes the most money if stock prices stay below $7 per share, and the break-even price on this trade is $7.20. You will, in real terms, pay $30 to enter this spread, and your maximum gain is $20 per spread. So that's it for this week's show. Thank you guys so much for listening. Thank you for learning alongside with me. It's always fun to know that you're learning. Thank you for the emails you send and the increase in numbers. We've had so many people start listening to the show this year. I am impressed and excited about the next year, especially knowing that I'm 2 years in. So I hope you guys are in it with me for the long haul. I'll be here suggesting trades each week. Thanks for listening again. Have a great weekend. Please be safe out there. And as usual, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.